Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, I want to talk about the art of profit taking. I have been trading and investing in stock markets since 2007. And in last 16 years, I have seen stocks that have doubled, tripled, given 10 times returns and even given 100 times returns. So it's natural for me to think that what if rather than doing all this active trading and investing for last so many years, I had just invested all my capital in this stock which has went on to give say 100 times returns, I would have been sitting at just as much net worth as I am right now. And it's not just my feeling. Anyone who has been active in stock markets would always look at charts or just the prices of stocks and think that what if they would have invested in this stock, it went on to become a multi-bagger and so on, and do nothing else and just stay invested in that stock. So here, the idea of profit taking is thrown out of the window and people start thinking about holding and sitting on your investments for a long duration. And why wouldn't they? Because we all come across the anecdotes where people invested 10 years, 20 years, 30 years ago, and now their dividend incomes are way more than what they invested initially. Warren Buffett usually boasts of about the dividend incomes that he has been receiving for stocks that he invested in 30, 40, 50 years ago. So when we come across these kind of stories, of course, our brain will start wandering and start thinking about, okay, this time if I would go ahead and purchase something, I'm going to stick with it as long as I have to because I believe in this stock, I believe in the story, I believe in its future. There's nothing wrong with that. Only to realize that the multi-bagger that we believed in so much did outperform for a long duration, may even rallied vertically, only to see that it kept falling sharply downwards, and probably us, the investors, are exactly where we started in terms of price. And it's no secret that in stock markets, the leaders of today will become laggards of tomorrow. That's how the stock market works. No sector, no industry, no stock can outperform for eternity. Statistically, not even possible. We all know about the Nifty 50 stocks. In US back in 70s, everybody used to swear by their future, right? And in US, there used to be a saying that nobody ever gets fired for buying IBM for their clients. It was mainly for the brokers, right? So you never get fired buying IBM for your clients. Why? Because it was considered safest stock. And even now, I'm sure you can enlist 20 safest stocks and they may not remain safe 20 years down the line. And in fact, IBM itself has been a laggard for last 20 years, right? Forget about the dividend income. It does have high dividend yield, but compared to other IT stocks, it has been underperforming by a huge margin. Nonetheless, the point is, when do we take our profits? And it's $1 million question, right? Because we're all scared of getting stuck in a stock that went up, but then fell sharply. And what scares us even more is, of course, not being able to ride the rally on a stock. For instance, what you're looking at is the Nvidia chart. So Nvidia printed its bottom back in October 2022 from the last bear market, right? So anyone who would have bought the stock at 110 would be sitting at a gain of almost 350 to 400%, right? And even if you did not buy at the 110 level, of course, it's impossible to pick the bottom with high conviction. Maybe you bought at 200, you bought at 300, right? You're still sitting on very decent gains. Even if you bought it at 300, you're still sitting at 33% gain with Nvidia currently at 400. So when do we take our profits? And this is where I want to talk about stock returns versus portfolio returns. You see, when I told you about me being active in markets since 2007 and seen multifold returns in stocks, here I'm not really talking about my portfolio return. Here I'm talking about the stock return. none of us ever would have the conviction to put in 100% of our capital in one stock. So comparing our portfolio returns, our personal performance with a certain stock itself is a futile comparison. So the point I'm trying to make here is, do not compare stock returns with your portfolio returns. And this is where the art of profit taking kicks in. It's a crime to not book your profit if you are seeing 30-40% return on your investments. Forget about taxes, long-term holding, dividends, and everything else that comes along with investing. But 30 to 40% return, when I see on my investments, I go ahead and book my profit. May not do it entirely, right? But at some stage, I do look to book my profits. Say I would book 25%, 50% of my profits, or maybe book to the level where all my investments have been recovered and whatever profit that I was running, that is still invested. So in a way, I've got that stock free of cost. But 30 to 40% return is almost always a case where one should look to book profit. And I will justify this reasoning here and why I'm talking about the 30 and 40%. As I said, we are not going to invest all our capital in one stock. So even if a stock goes on to become a multi-bagger, at some stage we would definitely book out our profits, but that stock's performance is only limited to the capital that we invested. As long as we're not 100% invested in that particular stock with, of course, 100% of our capital, we would never be able to get the same return that we think we would have, right? So that's what people don't understand. The performance of that stock for them is only limited to the capital that they've invested. And they haven't invested 100% of the capital. So it doesn't matter where it's going. What they should be bothered about is what they invested and at what level they exited. If you keep on booking your profits at 30%, 40% on the stock, be it completely or partially, you're anyway making sure that you're going to beat the index. You're coming back in cash as soon as you can, and you're trying to, of course, keep on repeating the same process over and over. Of course, here I'm assuming that you do have a way of finding stocks that go on to give you 30-40% return, and then look for the stocks that can give you that return very quickly. A 40% return generated in 10 years is not a good return, right? So if a stock gives you, say, just 10-20% return within a week, you should look to grab it, right? The earning is what comes home, not what you're seeing on the paper, right? My family needs food on the table right now, not 5 years down the line, not 10 years down the line, right? Nobody has ever gone broke after taking profits. Never, right? So the art of profit taking is 30 to 40%, look for an exit. If you do have a good system, chances are Nvidia will give you another opportunity to enter. Any other multi-bagger will give you another opportunity to enter. But opportunity to exit at a decent profit are rare to come by. So do not just let go of those opportunities. Now, why am I talking about the 30-40%? Actually, the logic is very simple. So what you're looking at on the screen is an Excel spreadsheet on compounding that I also covered in another video of mine where I spoke about generating $1 million and what kind of returns that we should be aiming for, and also in compounding, what's the most important factor that goes into generating higher returns for traders. This is exactly the same sheet. It's just that the rate of return that I've mentioned here is 35%, and the period in column A, let's assume that this is your yearly return. If you start with 100,000 with yearly return of 35%, then after 10 years, you'll be sitting at $2 million. And if you carry on, after 20 years, you'll be at $40 million. Yes, you're reading it right, $40 million. So it doesn't matter where the stock is going. If I can sustain a return of 35% on my capital, and mind you, it's not that easy because as your capital grows, you start become much more risk averse, which is what I myself have been realizing in the last few years. So every time I'm putting on my investment, or let's say a trade in a stock, and if I can churn so that I can aim at 35% return on a yearly basis, that's good enough for me. I don't care where that stock is going, right? Because I'm not 100% invested in that stock, right? So this notion that, oh wow, now my stock has doubled, let me see whether it's going to quadruple from here or not. Let's see if it can give me 10 times return or 100 times return from here or not. No, it's a flawed way of investing. It's utmost important to keep booking profits while you're in the stock markets. Very, very important, right? Because profits are not just there to raise your capital levels, but also to cushion you against the losses which you are going to get invariably in your stock market adventures. And how are you going to cushion against those losses if you're not booking your profits regularly? So one thing that I learned very early on in my trading investing career is that I have to keep booking profits, right? So that's the only way to sustain and thrive in stock markets. So when you see a multi-bagger, do not think of how you would have invested 10,000, 100,000 in it 10 years ago, which is a media story that sells really nicely, right? When you click on these kind of links where if you would have invested $1 on Amazon or in Microsoft or in Apple or in Nvidia, and you would have gotten that kind of return. No, nobody can do that, right? And of course, if you have to invest $1, by all means, go ahead and do that. Nobody cares about dollar, right? But here I'm talking about churning your profits. Now, this is the way that I follow in stock markets to increase my capital over and over. Of course, if I am saying that you should keep booking profits, it doesn't mean that those who have been holding for 20, 30 years haven't done well at all. They also have done well. But what good is that money if I'm going to get it after 30 years, right? What good is that money? I need that money now. So what you can really do is aim for 35% if you can achieve that. It's really good a return, and start taking some of the profits out of the stock markets and invest elsewhere or use it for whatever else you want to do. If you keep on doing that, your stock market balances, your investable capital, your portfolio size will keep on rising, and at the same time you will be able to fulfill your other obligations in your life, right? That is also most important. Many people, what they do is they keep on enjoying the thrill that comes with seeing their capital swell, only to see that they never actually booked out their profits, and all of a sudden the bear markets hit their stocks very hard and they're back to where they started. And I'm sure a lot of people can relate to that, especially those who don't have a system to exit the trade, be it in profits or losses, right? So never do that. Okay, so this is all that I wanted to cover in this video. I know a little more philosophical, not too much technical or methodical, but I really think that we should talk about these things. Profit taking is very important, and many people don't realize the importance of keep taking profits on a regular basis. Thanks a lot for being with me, and I'll see you soon.